All right, so there's a lot of talk this past couple of weeks about the yield curve inverting, more specifically the twos and the tens, where the 2-year yield was higher than the 10-year yield. So I did a lot of weekend reading over it. Just wanted to kind of get my head around it. So they're saying that when the yield curve inverts, specifically the 10 and the 2, it's a great predictor of economic recession. So here's a chart seeing below the zero line every time it inverts. These red shaded areas represent economic recessions. Here it happened again, happened again, happened again, happened again here in 2019. So okay, it's a yield curve. I'm not going beyond what this actually means. It's just, we'll leave it at that. It's a good predictor of economic recession. Economic recession usually means that there could be a fall or bear market in the stock market. Just bear in mind that the stock market is a leading indicator, so it's going to start to turn down before we actually get into the economic recession. In fact, the stock market may even be bottoming as we're in the throes of the economic recession. So just, you have to remember, it's a leading indicator. And here's another chart here just showing the same thing. Every time it inverts, the gray shaded area is a recession. So it's got a pretty good track record. Here's another one, same thing. It's all kind of the same chart. Same thing. So we can all agree that the inverted yield curve, the twos and tens, are a decent predictor of a coming economic recession. And that's what we're seeing in the news all week. Here's Morgan Stanley talking about the slowing economy, possible recession. RBC, slowing economy, potential for a recession. More and more. Right. So in the end, here's some more too. When the yield curve inverts, there's been a better than 2/3 chance of an economic recession at some point in the next year, and greater than 98% chance of a recession at some point in the next 2 years. So it's got some predictive ability. So how does the stock market? So now that it's inverted, what do? We get out of the stock market right now? The answer is no. So here's some of the returns when the 10 and the 2 invert. Here's the for the S&P 500, 21-day return, 42.63. So you can see right at the onset of the inversion, it doesn't really impact the market all that much. This guy here is going on to say these are the returns for the NASDAQ after first inversion. So there's actually been decent returns following the inversion. So it's not the time to get out right away. These numbers, these averages here might be skewed by this one 1998 area. Here's some more charts. This is the return. Let me move this over. All right, so this is the next 3 months total return upon yield curve inversion. So again, not terrible. Next 6 months, even so, still got some positive returns in here. 05 and 81 go down. This guy is saying here, and again, we'll double check it and all, but every recession for the past 40 years has been predicted by yield curve inversion. And again, he's saying that there's time. There was 422 days before the recession when it inverted in 01, 571 days in 07, 163 days in 20. So it's saying that the inversion of the yield curve gives you a lot of runway. It's a huge leading indicator of what's coming in the next maybe year and a half. So how long does it take before the market peaks after the first inversion? I thought this was an interesting chart. So this guy took the dates of the first inversion of the 10 and the 2 year, and here's the peak and the start of recession. So basically, the difference between the yield curve inversion and the S&P 500 peak is about 11 months on average. So with the yield curve inverting last week, I would say that we have almost a year, maybe 11 months out before we actually see the peak in the S&P 500, according to this chart. This one is pretty interesting too. So this is telling me that historically the S&P 500 has not peaked until months after the yield curve inversion. So what we're seeing here is that she's saying that the average from first inversion to market peak, the average is about 10 months, which is not too far from that other person's 11-month forecast. and she's over here saying that the average return over those 10 months has been about 10% or so. That's 10% or so. I'm sorry, yeah, maybe 11%, 12%, whatever that is, but there is some potential upside here. Now this is saying, so the S&P's made gains before the start of the next recession. So this is kind of looking at from the start of the recession to the peak, but once again, it's kind of bringing to point after the inversion, the market has tended to go higher. It tended to peak at some point, maybe 10, 11, 12 months after, and then the market starts to go down, and the market tops about 18 months before the recession. So I did some research here. Let's take a look at the times when the yield curve inverted. So the first inversion here that I recorded was August 18th, 1978. It's the first inversion. So the market came up here a little bit, about 2% over the next 2 months. Sold off. It was down 14% over 64 days. Then it kind of ran. It inverted again, and if you take a look at what this looks like back then, this is the 10s minus the 2s. This whole area between like 1978 and maybe 1982 is kind of up and down here. So I'm kind of counting this as one period. So we'll go back to the chart here. So this was the first inversion. Here's that market low. Here's the second inversion. Here's the third inversion. So it's that cluster of inversions that we saw. But we see here that the market went on to peak. Market peaked around November 27th in 1980. This is it's up 32% since the first inversion, and it was 832 days since the first inversion. But then the market went on to sell off. It was down 28% over 622 days. So that's your run up, and this is your decline. So again, my lead time here, if I count that all those inversions as one cluster, one period, we're looking at 832, up 32%. Let's take a look at the market in 1988. So the first inversion, early December, 88. Market went on to run, kind of peaked, came down here about 8%, came back again, then peaked here and then started this sell-off. So market peaked was up 34% from the first inversion. That was over 580 days. On July 16th it peaked. Then it went on into the bear market, sold off 20% over 87 days. So again, gave us lots of runway here to get ready for the coming bear market. So again, my point here is I'm not taking aggressive action because we do have some time. Just we're on alert. Here's in 1998. First inversion here was May 1998, and then it sold off 20% over 78 days. So you can kind of consider this the bear market, but okay, it came back again, peaked here in March of 2000, and this was a gain of 39% over 668 days from the first inversion over here in 1998. Then this market went on into the bear market, and we lost 50% over just under 1,300 days. Pretty brutal. And here's a 2006 inversion. So actually it happened in late December 2005, the first inversion. The market did go on to rally. It was up 24% over 715 days, topped, and then went on to sell off. This was down almost 60% from this peak, and this sell-off happened over the course of 453 days, and then obviously we rebounded from there. And the last one, this is the 2019 inversion. So this is in August 2019. Market did go on higher. It was up 16% over 177 days after the first inversion, then went on to sell off 35%. This was over 33 days, so this is really quick, massive sell-off, and then we kind of rebounded pretty quickly. So I guess what I'm trying to say here is that we do have time from the first inversion, so I'm not going to go ahead and put everything into cash now. I'm just going to be wary that over the next couple of months into next year, we could be seeing some type of market pressure. Here's another interesting tidbit. So what this guy's doing is he's taking a look at a series of yield curves. So he's got a whole bunch, he's got a cluster of yield curves, and he's telling us right now the percent of those clusters that are inverted. is a good indication of a coming bear market. So, right now he's saying that we're only around 10% of all the spots on the yield curve that he covers that are inverted. And he's saying that, typically 50, 60% is when you need to get worried. So he's saying, don't get worried yet, just be on alert. I saw something similar here. Ignore the yield curve inversion noise. The time to panic is when 60% or more of the 45 possible yield curves are inverted. Currently, only 10% have inverted. So, kind of saying the same thing as here. 10% of the curve is inverted. Here, 10% of the curve is inverted. We need to get up here somewhere around 60% or so before we start getting nervous. So I kind of went in and I did my own invert. So I took a series of differing yield curve scenarios. All right, so whatever. I went all up and down the yield curve, and I decided to determine for myself what is inverted or not. So I laid it out here. So back here in the 78 to 80 crisis, the yield curve was 100% inverted right around here, and then you had this kind of downturn. This was that crash of 87. Right here in the 1998 area, about 90% of the yield curves that I tracked were inverted. Then we had this sell-off, this bear market. Over here in the 2000 market sell-off, 80% of the yield curve that I was tracking was inverted. This kind of gave us, kind of peaked right at the peak of the market. So didn't give us that much of a warning, but 80% of the yield curve inverted is a warning sign. Here in 07, 60% of the yield curve was inverted as I calculated, and this gave us gave us a year advance notice. And then the market went on to sell off. And then right here was the 2019 inversion. This only got up to 30% inversion. That was the peak. Then we had this quick sell-off, and then it kind of rebounded next month. Today, according to the yield curves that I was tracking, we're currently at 29%. So we're right around here right now. So are we concerned yet? Yeah, we're keeping an eye on it, but I'm not going to, like I said, I'm not liquidating everything. I'm not going to cash. I'm just going to be able to trade the market and let it dictate where I should be. So speaking of looking at the market, I'm going to show you one last thing and then I'm getting out of here. So this is where we are. This is the S&P. So here's the rules that I like to see. And this is kind of two rules that apply to the last bear market, the last two bear markets, one in 2000 and 2008. So one, I'm watching when the MACD histogram goes negative. So that is this histogram that drops negative right here. That's this point here, goes on a watch list. And then I'm watching for a breach in the RSI. So that's the 14-month RSI, and in the 20-month SMA to the downside. So here we breached the 50 level on the 14-month RSI, and we breached to the downside this 20-month moving average. The 20-month, then I'm waiting for this 20-month average to slope negative. So you see here it starts to curl over and go negative. Then we're going to see an attempt to retest both the 20-month moving average and the RSI. So you can see here it came down, started sloping negative, came back up, tried to retest it, and then the histogram turned negative again, and we tried to test the 50 level and failed. So this is a sure shot sell signal for me. So basically we would have been out of the market or short the market during this red shaded area or so. Similar story here in the 2008 crash. So the MACD histogram crossed negative right here. We breached the 20-month moving average. We breached the RSI down to the 50. We came back, tried to retest this downward sloping 20-month. We came back, tried to retest and failed, and that would be our signal to get out. So we would probably been, this would have been the signal to get out, so we would have missed all of this downside. In 2015, I had some of the signals, but it never fully followed through on all the signals. So we kind of had this flat, shallow area, and then MACD crossed higher again, so we got the buy signal. So here in 2019, we had this sell-off. It came down, tried to retest, and broke out. So it wasn't quite the signal, the sell signal that we wanted, which is good. It kind of kept us from going into cash or taking a short bias, and we would have missed this upside. So it worked in that case, and here too. So in the end, here we are today. So this MACD histogram has gone negative. It has crossed. We have not breached the 20-month moving average, and the 20-month moving average is still sloping higher, and we have yet to breach this 50 level on the RSI. So I guess looking at the monthly chart kind of corresponding to what I'm feeling about all the research on the inverted yield curve, don't start to panic yet, but let's just keep an eye out for a topping process and possibly the start of the next bear market, which may be towards the end of this year or middle of next year. So we don't know, but we just have to try to be vigilant and be prepared. That's some research and some weekend reading on the yield curve. Happy Monday. Have a good day.